for each year of expected useful life of the asset. Now, what I'm talking in essence is that if a depreciation charge at the end of the day is 5 years for 500 for good 5 years, and it is the expected useful life is 5 years, that means equally will be charged. Depreciation will be charged equally to each year. That is what straight line method charge an accountant to, that all the depreciation must be charged equally. That means if the amount of depreciation charged in the first year must be the depreciation that have to be charged the second year until you allocate them to the number of the useful life of the asset. And that's what brings us to formula. This is the formula. You know, we talk about the element of depreciation, which is cost, and that is the first thing you need to consider when you are preparing a depreciation. The first thing is you first write the formula. The formula is cost minus scrap value minus number of years, which is the economic useful life of an asset. So before we go to illustration, let's assume an asset is 300, and at the end of the day, the scrap value to be disposed of is 50 naira, and the useful life of that asset is 5 years. So now under straight line method, I join us to minus this from this, because when you bought an asset at the rate of 300 naira, and after using it for 5 years, you sold it at 50 naira. So how will you charge your depreciation is this minus this, that will give you a 250. So 250, it is the amount that is depreciated from this asset, whereas you sold it 50 naira, which is the salvage value or the scrap value at the end of the day. So you just divide, since the straight line adjourn accountant to give equal amount to that, depreciation must be charged equally to the number of the years. So if you just divide this from this, you see that 50 years, 50 naira must be charged for good 5 years. That is what a straight line method is telling us here. Now let's go to the illustration, and we'll prepare necessary ledgers that is involved. You know, we have different type of ledgers that we are to prepare. But the first thing is that if you are given an illustration like this, you must first write the formula, and that's very important because it attracts marks. So because they want to know how you get the depreciation at the end of the day, and you prepare the necessary ledger. Here we go to the illustration. The cost of motor car is 3,000 naira. The scrap value is estimated as 200 naira, while the estimated useful life is 4 years. Now, use the straight line method to prepare the necessary account. Here, what we now do is, don't forget our formula, cost. Don't forget cost minus the scrap value divided by numbers of years. Now, what is the cost? The cost of that asset is 3,000 naira minus the estimated scrap value is 200 naira. Then the number of useful life is 4 years. Now, subtract this from this, it will give you 2,800. So you divide it by 4, that will give you 700. So 700 naira will be charged for good 4 years. So 2,800 is the depreciation that was charged, and you spread it to the 4 years, which is 700, and it must be equal at the end of the day. So we begin to prepare the necessary ledgers that is required, that we are required to prepare under the straight line method. So now the 4 ledgers that you are to prepare is: number 1, you prepare asset account. That is the first one. Then the second one, you prepare provision for depreciation account. Then the third one, you prepare profit and loss account. Then the fourth one, you prepare balance sheet account. That is the reason why those we did in the SS1, we talked about the trading profit and loss account. Those are the fundamentals because it's also applicable to other topics in accounting. So as we prepare that, we also prepare balance sheet for that. Now, the asset that is involved is motor car. So the first one is you prepare motor car account. Don't forget our double entry principles. Now, are you to debit motor account or to credit it? Because motor account is an asset, so it has to be debited. You see, the ledgers we must apply double entry principles. So here we just write year 1 cash. How much is the cost of the motor car? It is 3,000 naira. So this is how you prepare a motor car account. Then the second one is a provision for depreciation account. Here you charge, you know that our depreciation for each year is 700 naira. So you charge that 700 naira for good 4 years under this provision for depreciation. Now, anything that has to do with provision has to be credited in the account. The double entry principles apply to provision. Any provision, is it provision for bad debt or provision for depreciation, it has to be debited. So you write year 1, then December 31st, profit and loss. The first year is 700 naira. Then you write year 1. You now bring it forward as a December 31st balance carried down, which is 700 naira. That is that for year 1. And year 2, you know, depreciation is spread for good 4 years and 700 naira for each year. Then you write January 1 balance BD. That means you carry the first one down here, which is 700 naira. Then that of the second year, December 31st, profit and loss. So the second year also is 700 naira, making 1,400 naira. Then you transfer it as December 31st balance CD. That is 1,400 naira. Then you balance that. So that is that for the second year. You know, it accumulates 700 second year, then second year it become 1,400, then third year it become 2,100, and third year it become 2,800. So these are we prepare. Then year 3, we have January 1 balance BD. You brought it down here as a 1,400. Then that of third year, December 31st, profit and loss 700, which gives you 2,100. Then year 3, balance CD, which is 2,100. Then the last year, which is year 4, you know, you charge depreciation for good 4 years. So January 1, 2001, you brought it down here. Then December 31st, profit and loss, that is 700 naira. So which gives you 2,800 at the end of the day. Then you brought it down here, 31st, balance CD 2,800. Then you balance it. So these are you prepare trading provision for depreciation account in the second year. So we're going to the third year, which is you prepare your profit and loss. You know, depreciation in a trading profit and loss account, it is an expenses for a business. So, and that's why when the expensive side of the trading profit and loss account, you see that depreciation is charged in the expenses. So you now prepare the profit and loss for the 4 years.